let's continue the Chapter 7, Portfolio Management Strategy. In this class, we will talk about 7.3, the asset allocation. For this part, we will first introduce the asset classes, what kind of asset classes we will use. And the second one, we will talk about the strategic asset allocation, SAA. And third one is tactical asset allocation, TAA. And finally, we will compare the security selection and market timing. Now let's have a look. For an investment strategy, there are 4 questions you will think about. The first one is what asset classes to be considered for investment. The second point is what policy weight to assign to each asset class. So that's the SAA. And the third one is determine the allowable allocation range based on the policy weight. And then you can make some adjustment between different assets allocations. So that's the TAA. And the last one is what specific security to purchase for the portfolio. That's the security selection. So finally, you need to decide in the asset class which kind of specific securities you want to invest. Now let's have a look. The first part is asset classes. We have different asset classes. So for the asset allocation, as a mutual fund manager, you need to decide which kind of asset class you want to invest how much money. And the first one is the equity. Let's have a look at the equity part. We can separate for domestic equity, foreign equities, and also we can separate as the large cap stocks and the small cap stocks or emerging country stocks or developed country stocks. So we have different categories in equity parts. And the second asset class is the bond. For bond, we can also separate for foreign bond or domestic bond, government bond or corporate bond, investment grade bond or speculative high yield bond. For this speculative high yield bond, it's much popular in US. We can also call it junk bond. So this is very famous bond in 1990s, and lots of companies using this junk bond to merge the small companies. And for this part, it's not very popular in our countries because, so this speculative high-level bond definitely will have a lower rate. And the low rate bond in China, they have the problem to issue them. So this kind of bond is not very popular in China. And the third group is the cash. In the portfolio, definitely there will some cash, and especially for the mutual fund. In the mutual fund, if the fund manager have expectation that the investor will redeem their mutual fund shares, it will need the cash to pay them back. So sometimes the mutual fund manager will keep some % of their investment in the cash in case of the redemption. And the next part is the realist. The realist part is very famous in China. Lots of Chinese investors, they invest most of their money in the realist, and the rest of them in, I think, is in stocks or in the mutual fund. And this is a very popular one. And also the literature might put the realist in the alternative investment. And the last point category is the alternative investment. The alternative investment is very popular only in recent years. And they include hedge fund, private equity. So this private equity is PE, or we can have the VC, the venture capital, and also the commodity fund, artwork, intellectual property rights, etc. So all of these are included in the alternative investment. the popularity about alternative investment is because the correlation of alternative investment assets is less correlated with stocks or with the bonds. So if you include alternative investment assets in your portfolio, it will have a well-diversified effect. So that's why the alternative categories is more popular recently. Now let's have a look at the strategic assets allocation, SAA. So what's the strategic assets allocation? It is used to determine the long-term policy assets weight in a portfolio. So it's very important. It is a policy weight. So before you are doing any assets allocation or portfolio management, you need to decide how much money you want to invest in bond and in equity or in real estate, in cash or alternative investment. So that's the policy weight you decide before your investment. And this is policy weight is depend on your historical information. So specific the percentage allocation to the include asset class and modified infrequently. So if you are doing SAA, that policy weight modified infrequently, you need to understand. And the last one is the long-term average assets return, risk, and covariance are used as estimate of future capital market result. So we use the assets return, risk, and covariance between different assets class to determine the allocation between this assets class, the policy weight. Efficient frontier are generated using historical information, and investors decide which asset class mix is appropriate for this needs during the planning horizon. So that's the SAA. So doing any active portfolio investment construction, you need to decide what's the SAA for your portfolio. And the next part is tactical assets allocation, TAA. For TAA, it's vary from strategic assets allocation weight in order to take advantage of perceived short-term opportunity. In other words, after you decide your policy weight, SAA, and you anticipate the market expectation, if you find in the short term the equity will goes up, so you will increase the proportion to invest in equity. So definitely that's the TAA. It's the deviation from your SAA. And second point is frequently adjust the asset class mix in the portfolio to take advantage of changing market condition. So compare with SAA. SAA is modified infrequently. However, the TAA, you will adjust it frequently based on your market condition. So if you make any expectation, you can doing this adjustment. The TAA adjustments are driven by perceived change in the relative value of the various assets class. The investor's risk tolerance and investment constraints are assumed to be constant over time. And the success of TAA, there exists a short-term opportunity in specific asset class, and the manager has the ability to identify them. In this case, there exists opportunity, and also the manager has the ability to identify this opportunity. Both of them together will have a success TAA. Now let me show you an example for this TAA. Suppose the ratio of stock and bond return is normally 1.2. This reflecting the greater degree of risk in the equity market. And if you are a mean reversion investor and you assume the market is mean reversion, and you find that the stock return was suddenly doubled, So it is, original is 1.2, that's the average level, but now it is 2, doubled, and the tactical investor might determine that the bond is undervalued relative to stock. So in this case, they will overweight the fixed income, overweight the bond. And also, if you are the contrarian investor, which is the same as mean reversion meaning, if you are contrarian, definitely you will invest the stocks or the bonds which has the lowest level, and then you think it will recover. So you will buy the asset class that is currently out of favor and selling the asset class with the highest market value. So it definitely will think that the stock will have the highest market level and sell the stock. So they will underweight the stock allocation and overweight the fixed income. So both of them have the same strategy. But if you are a momentum investor, you assume the market follow the momentum structure and the stock will keep going up. In this case, you will overweight the stock and underweight the fixed income. So I didn't include the momentum factor in this slides. You can add it by yourself. If you are momentum, you will overweight the stock and underweight the fixed income. So that's for the tactical investor's view. So you are doing the tactical assets allocation to allocate your weight based on your view. Now in this slide, I will show you an example for strategic assets allocation and tactical assets allocation, the SAA and TAA. Let's have a look at this table. On the left-hand side, it is the 2002 year-end data, and on the right-hand side is 2005 year-end data. Let's have a look. The first column is our asset class, and we can see we have different asset class from U.S. equity, non-U.S. equity, etc. And the second column is our actual allocation. So this is the actual portfolio investment weight. And the third column is our strategic assets allocation, which is our policy weight. And the last one is our tactical adjustment. So this is the TAA. For this tactical adjustment, it should equal to our actual allocation, which is column 2 minus the strategic assets allocation, the column 3. And we can get the tactical allocation. And this example here shows the tactical adjustment made by the fund manager. The adjustment can be measured as the difference between the actual and strategic asset allocation. The fund manager went from being underweight in the U.S. equity categories in 2002 to being slightly overweight in 2005. So you compare the data, you can find this trend. And the next is the opposite movement for U.S. fixed income, which saw its tactical position fall from an overweight of 0.8% to an underweight of minus 1%. So from the table, you can see that. And obviously, there is a strong view against the fixed income investment. So both of these tables show you that we don't think the fixed income will give us a higher return, so we underweight the fixed income investment. The underweight position in the private equity are likely due to manager not being able to invest all of the money they had planned, which would also explain overweight position in their cash account. So the manager think they may not have that ability to manage that, so underweight position in private equity and overweight the position in cash account. So that's the assets allocation part. The last slide we will talk about is what's the difference between security selection and market timing. For the active return, generally, there are two ways for the fund manager to generate active return. One is based on the manager's skills of market timing. The other is based on the manager's skills of security selection. For the security selection, it is the deviation of index weight on individual securities within an asset class. So within an asset class, you can decide which we can overweight some stocks and underweight some stocks. And the success of security selection is based on the manager's skills and the opportunity within a particular asset class. The market timing is a bet on the direction of the market. It is like asset allocation and the sector allocation rotation. And the last is we call the core satellite approach. That's the asset allocation approach. And the investor invest the majority proportion of their portfolio in passively managed index and invest a smaller proportion in active strategy. So that's a very famous recently strategy, core satellite strategy. We invest most of our money in the passive part and only a small part for the active part. So we can earn the market risk premium and also we can earn our active return from this strategy. Besides the core satellite approach, for the assets allocation, we also have Black-Litterman model and more advanced model used by mutual fund. So if you are interested about that, in the future, I will show you how can we do the Black-Litterman model based on the manager's view about different asset class and each individual assets. Okay, that's all for today's class. We have discussed the asset allocation and show you what's the asset class and what's the SAA, TAA, and also the security selection and market timing. Thank you so much.